We often spend a lot of energy, fortifying our businesses against external forces, competition, market shifts, cyber attacks even. But here's the thought. What if the threat is already inside the building, maybe even on the payroll? Today we're taking a deep dive into something critical but maybe sometimes overlooked, safeguarding your physical assets, your inventory, your equipment. From internal theft, we're going to break down a pretty robust framework for preventing these things and, well, detecting them too.
That's right. And the core of our exploration today, it actually stems from a really comprehensive guide. We're calling it an Inventory and Equipment Theft Prevention Checklist. But don't let the name fool you. This is far more than just, a simple list. It's really a strategic roadmap. Helps you understand your weak spots, shore up defenses. And for you, our listener, it's worth noting the insights we're pulling from today. They come from a script prepared by Yazan Abu-Ghosh, who's a certified fraud examiner, working with EasyPathUni. The original template itself, which Yazan Abu-Ghosh reviewed, is provided by the Association of Certified Fraud Examiners. So it's solid stuff. Our mission here, it's really to arm you with the critical insights needed to spot those hidden vulnerabilities, build stronger defenses against, various kinds of internal asset theft. Make sure you're well-informed, ready to act.
All right, let's pull back the curtain then. Before we even think about prevention, it seems really helpful to understand how these thefts actually happen. Like, what are the common ways employees might try to misappropriate inventory or equipment? Because if you know their playbook.
Yeah, absolutely. If you know what it plays, you can build a defense, right? Our source breaks it down into 6 main schemes that organizations often see. First up, fake sales schemes. This one's pretty clever. An employee works with an accomplice. The accomplice pretends to buy stuff, but the trick is the employee either never rings up the sale or maybe they void it right after. So the goods just walk out the door. No payment.
Huh. So it looks like a real transaction maybe for a second. But the cash never lands. The company gets hit with a sort of phantom sale. That's sneaky.
It is sneaky, precisely.
Yeah.
Then you've got purchasing schemes. So imagine an employee, they have the authority to place orders, right? They misuse that power. Maybe they buy stuff, maybe even at inflated prices, but their whole plan is to steal those items themselves once they arrive.
Wow. So it's abusing their position right from the start of the supply chain.
Exactly. A real breach of trust. The theft is kind of baked into the procurement process itself.
Okay, what else?
Next, we see receiving schemes. This one happens literally at your doorstep. As assets are coming in, off the truck maybe, an employee just diverts them before they get properly logged into inventory. They might never even make it onto the official records.
So the company might not even realize it had them to begin with, in a way.
That's exactly the problem. Then things get a bit more elaborate with false shipment schemes. Here, employees actually create fake sales documents, fake shipping papers. The whole point is to make it look like missing inventory was legitimately sold and shipped out, when really, it was stolen. It's an accounting cover-up.
Okay, that sounds like it needs some real insider knowledge to pull off, and definitely needs a strong paper trail to counter it.
It really does. Number 5 is misuse of company assets. This one might seem a bit less severe, maybe, but it's super common. It's basically an employee borrowing company stuff, tools, equipment, maybe even a company vehicle for personal use. Without permission, obviously. I think, taking a company van to help a friend move over the weekend. The danger here is that this borrowing, if it's unchecked, it kind of normalizes taking company property.
Yeah.
And it can easily escalate.
Right, and it often flies under the radar because it's not like something permanently disappears. It's just an unauthorized loan.
Exactly. And finally, the 6th one, larceny schemes. This is the most, straightforward type, almost blunt. It's just when an employee takes inventory from the premises, they don't even try to hide it in the accounting records. They just take it, walk off with it. Often these are maybe smaller items first, things that might not be missed right away, until, a big inventory count shows a major discrepancy.
Okay, well, it's really clear that knowing these different methods gives you a huge advantage. You can see how each prevention step we're about to talk about is designed specifically to plug one or more of these holes. It's like understanding your opponent's moves before the match even starts. So knowing how they do it, that brings us to the big question, how do we stop it? Where do we even start building those defenses? What are the absolute basics, the foundational practices for just keeping track of your assets?
Right, the foundation. Well, the bedrock of any strong defense is having robust, consistent inventory processes. Think of it like painting a really clear picture of what you own and constantly updating it. First and foremost, you need regular independent counts. This means actually counting your equipment, listing serial numbers, descriptions, all of that. And crucially, someone from outside the department that holds the inventory, they should be doing that department's count. You also want someone independent of purchasing, receiving, and warehousing to physically count the inventory. Get multiple eyes on it, these counts. They should be subject to independent recounts. And you should definitely throw in surprise counts sometimes. That independent verification is key.
Yeah, that makes total sense.
Mm-hmm.
An independent set of eyes is way less likely to overlook something or, intentionally miscount.
Exactly. And beyond the physical counts, you need diligent record keeping and reconciliation. This is all about the data trail, making sure any weird entry screams out for attention. You have to examine any unexplained entries in your inventory records, find the source documents, and periodically do these analytical reviews. Look at your beginning inventory, your sales, cost of goods sold, ending inventory. See if the numbers make sense or if there are unexplained gaps. And if the physical count doesn't match your records, you have to investigate that difference before you just adjust the books. Find out why. Your perpetual inventory system, that's your live running record, it needs to reflect every single transaction in and out. And here's a really critical control. Get approval for any adjustments to inventory records, especially write-downs. Don't let just anyone do that. You also need clear procedures for counting trickier stuff like work in progress or things that need volume conversions. Specify how to record counts. Oh, and during those big physical counts, absolutely suspend shipping and receiving. You need a clean cutoff point.
That's a lot of detail, yeah, but you can really see how it all connects. If the books don't match reality, boom, there's your red flag. Something needs looking into.
Precisely. And one more thing on the foundation. Think about handling specific inventory types. Make sure everything is reasonably identifiable. Clear descriptions, conditions, stage of completion, so it gets classified right in your system. And don't forget scrap. It needs to be inventoried too. And its disposal needs accounting for. Review who authorized any scrap sales. Also, properly identify and segregate anything obsolete, slow-moving, or damaged. Keep it separate. If you don't, it can easily mask theft or just mess up your inventory values.
Okay, it's really clear how these steps build that meticulous, real-time picture. Makes it so much harder for stuff to just vanish unnoticed. You're building this chain of accountability from the dock to the shelf to the door. All right, here's where I think it gets really interesting. Because inventory isn't just sitting there, right? It's constantly moving in, out. How do we stop theft at those critical points, the entry and exit points? It seems like there are just so many opportunities for things to go wrong there.
You're absolutely right. Those are definitely high-risk areas. It really all comes down to implementing incredibly robust receiving procedures. First off, a detailed receiving report. It must be prepared for all goods that come in, period. Then, copies of those reports. Send them directly immediately to both purchasing and accounting. Keep everyone in the loop. And importantly, the receiving team needs a copy of the purchase order for everything they're expecting. Any partial shipments, they need to be clearly marked on the PO or on separate sheets attached to it. Things like overages, shortages, damage reports, those need to be completed and sent to purchasing and accounting too. Keep that communication flowing. And obviously, count the quantities received, compare them to the OPOs. That's fundamental. The warehouse manager, they should have to reconcile the receiving report with the actual goods for every single shipment coming in. And here's a big one. Accounts payable must compare the invoice to the receiving report before they cut that check. No receiver report, no payment. And finally, you need to be constantly monitoring the procedures and the personnel involved in receiving.
Okay, so it's like creating this multi-layered web of checks and balances right from the second something hits the loading dock. Everybody has to confirm what everyone else is seeing. No single point of failure.
Exactly. And that same level of, granular control, it applies to stuff going out too. With controlled shipping processes. First, the shipping function itself. Keep it totally separate from purchasing and inventory functions. Segregation of duties is key here. Always use shipping documents that are pre-numbered and make sure you account for every number. Critically, match those shipping orders back to sales orders or contracts. Make sure it's a legit shipment. Goods should not leave the building without an authorized sales order or contract backing them up. Prior authorization is essential. And once something is shipped, those shipping docs go straight to accounting, so they can immediately record the inventory reduction and the cost of sales. Keep the books updated in real time. Oh, and always include an itemized packing slip in the box going to the customer.
Right. So it's not just tracking what comes in meticulously, but just as diligently tracking what goes out, and making sure every single departure is legitimate, authorized, and accounted for. Creates that full loop.
Precisely. And the thing that ties both of these movements together, receiving and shipping, is that bedrock principle of critical segregation of duties. This is probably one of the single most powerful controls against internal fraud. Think about it like building a bridge, right? You wouldn't have just one person designing it, ordering all the steel and pouring the concrete by themselves. That'd be crazy. Segregation of duties is like your internal control bridge. It makes sure no single person holds all the keys to the kingdom, so to speak. You absolutely must separate the jobs of requisitioning inventory, receiving it, dispersing it, writing it off as scrap, and handling the money from scrap sales. Those need to be different people. And similarly, the duty of actually disposing of assets needs to be separate from whoever receives the money from selling them. Break up the process.
Yeah, it's so clear how those detailed checks plus that vital separation of jobs create this really robust audit trail. It makes it incredibly hard for discrepancies to just slide by unnoticed. It forces multiple people to be involved, which adds layers of protection. Makes it way harder for someone to just, go rogue. Okay, so beyond the paper trail and the physical movement of goods, there's the human element, right? And the physical space itself. What policies and security measures are really essential to create an environment, ecosystem, that genuinely deters internal theft? What's that sort of hidden piece organizations sometimes miss?
You're hitting on a really vital point there. It's not just about the processes on paper, it's about the culture of accountability and the actual physical safeguards you put in place. Let's start with physical security measures. Seems obvious, but critical. High-value items. They always need to be stored in secure areas, maybe even continuously monitored areas. It's also really essential to properly supervise those high-traffic spots like shipping and receiving areas, prevent theft right there, and maintain strong physical security over any high-value or high-risk items in general, and secure the whole perimeter of the building, make it harder to get in and out without authorization.
So it's more than just locks on doors. It's about active vigilance, especially in those vulnerable zones.
Yes, exactly. And building on that, access control is absolutely paramount. Use access logs. Track who goes into restricted areas. If it makes sense for your setup, assign personalized entry codes to employees who need access on weekends or after hours. Don't use generic codes. And critically, this sounds basic, but it gets missed. Change those access codes and locks immediately when an employee leaves or is terminated. Don't delay. Also, you need strong access controls over your computerized inventory and accounting systems, too. Remember, physical theft can start with a digital breach sometimes.
That's a really good point. A digital weakness can absolutely lead to a physical loss down the line. They're linked.
They absolutely are. Then you have some essential policy and monitoring measures. Your organization really should have a written policy saying management can inspect desks, file cabinets, other containers on company property. Makes the rules clear. Implement an equipment removal policy. Needs written management approval before any company equipment leaves the premises. No exceptions. Require inspection of packages, boxes, personal bags maybe before they leave the premises. And yeah, periodically monitor trash removal. Sounds mundane, but you'd be surprised what can be hidden in trash receptacles.
Right, so it's about making sure nothing just walks out unchecked, even if it seems innocent like taking out the trash.
Exactly. You also need to create and communicate a really clear policy on personal use of company assets like vehicles or tools. Maintain mileage logs on company cars. Compare them to the stated business purpose. Does the mileage make sense? Require authorization for any fixed asset stuff, purchases, improvements, retirements, even just adding or deleting things from the fixed asset accounts. Get approvals. All materials requisitions. Signed by the person requesting and approved by their supervisor. 2 sets of eyes. And this one is surprisingly simple, but really effective against ongoing schemes. Require mandatory vacations for employees and key inventory roles.
The mandatory vacation thing, that's interesting. How does that work?
Well, think of someone running a fraud scheme like a juggler, right? They're constantly managing things, covering tracks. A forced vacation means they have to drop those balls for a week or two. Someone else steps in, even temporarily, and might notice inconsistencies that the person was hiding. It disrupts the scheme. And finally, investigate employees who are frequently coming into warehouses or stockrooms after hours or on weekends. It might be perfectly legitimate, but unusual patterns warrant a closer look.
That's a really important distinction, though. It's not about creating this atmosphere of, distrust or suspicion around everyone. It's really about setting clear boundaries, creating an environment of accountability, and honestly, safety for everyone. When the rules are clear, good employees feel protected, and the bad actors, they're deterred. Okay, so even with all the best prevention in the world, things can still sometimes slip through the cracks, right? So what are the warning signs, the red flags we should be looking for? How do we actually detect theft if it's already happened or maybe it's ongoing? What are those clues?
Yeah, detection is crucial. This is where you need to be actively looking using investigative techniques. Look for key red flags and conduct investigations. For instance, investigate big inventory increases if you don't see comparable sales increases. That could be someone cooking the books, overstating inventory. Always investigate any unusual volume of inventory adjustments, write-offs, or disposals. Why so many suddenly? Review sales that get canceled after the goods have already been shipped out. Where did those goods go? And scrutinize shipments where there's no corresponding sale booked at all. That's a huge red flag.
Right. If something left the building, but there's zero official record of it being sold, that screams problem.
Exactly. Also, review sales where the shipping address is an employee's home or maybe even a competitor's address. Classic collusion sign. And look closely at sales tickets that show signs of being altered. On the purchasing side, investigate purchases you just can't trace to your inventory. Where did that stuff go? Or investigate purchases where you paid full price, but the shipment was supposedly missing items or had defective goods. Why pay full price then? Always investigate the money received from selling scrap assets. Make sure it matches what you expected. And here's a subtle one. Investigate unexplained spikes in your bad debt expense. Sometimes an employee might create fake sales to cover up stolen inventory, then just write it off as bad debt.
Wow, that's a pretty sophisticated way to hide theft. Making it look like just another customer who didn't pay takes a sharp eye to catch that kind of financial manipulation.
It really does. And beyond looking at individual transactions, trend analysis is incredibly powerful. Perform trend analysis. Look for unexpected increases in uncollectible sales or bad debt expense over time. Also look for trends of, say, excessive purchases of materials or merchandise. Is it way more than usual? Why? And conduct historical analysis of your inventory shrinkage. That's your unexplained loss. Are shrinkage levels climbing significantly? That often points to theft.
So it's not just about spotting single mistakes or weird transactions, but seeing the bigger picture, the patterns that emerge over weeks, months, maybe even years.
Precisely. And finally, verification and cross-referencing are just crucial detective tools. Verify that all your equipment additions are properly authorized, reconciled, and physically check is the equipment actually there, in the company's possession. Compare shipping addresses against employee addresses, maybe even against addresses of other vendors you use. Look for those suspicious connections, and leverage your tech. A good automated perpetual inventory system should flag you when inventory levels drop below a certain reorder point unexpectedly. That can alert you to abnormal usage or disappearance much faster.
It's clear these analytical steps provide that vital safety net. They let organizations spot those patterns, those anomalies that might signal fraud, even if some preventative measures were somehow bypassed. It's like having an ongoing internal audit function, really. Well, we have covered a ton of ground today, from unmasking those subtle tricks fraudsters use, all the way to building this really comprehensive, multi-layered defense system. This deep dive has really laid out a detailed blueprint for how you can protect your organization's physical inventory and equipment. And it's clearly about way more than just, locks and cameras. It's about cultivating this whole ecosystem of prevention, continuous oversight, and diligent detection.
Indeed. And it's important to remember, no single control is ever going to be foolproof, right? But the combination, diligent processes, independent oversight, strong physical security, strong digital security too, and that continuous analytical review, that combination, creates a really formidable barrier. The real challenge for any organization, though, isn't just putting these things in place once. It's maintaining that vigilance, that constant awareness, and being ready to adapt as new risks, new methods of theft inevitably emerge. It's definitely an ongoing commitment, not just a one-time project.
Absolutely. And on that note, here's maybe a provocative thought for you, our listener, to consider as we wrap up. What hidden vulnerabilities might be lurking in your own organization, maybe even hiding in plain sight? And how might a fresh pair of eyes, perhaps even your own, looking differently now, uncover them? Think about the processes, the patterns you see every day. Where might the gaps be?